The U.S. Federal Reserve has voted to keep its benchmark interest rate unchanged, marking the fifth consecutive policy meeting without a rate adjustment. The decision reflects the central bank's cautious approach as it continues balancing persistent inflation pressures against signs of moderating economic growth. While inflation has eased from previous highs, Federal Reserve officials indicated that price stability remains their primary objective. Policymakers emphasized that future decisions will continue to depend on incoming economic data, including inflation, employment, consumer spending, and overall financial conditions. The announcement was closely watched by investors, businesses, and consumers, all seeking insight into the direction of U.S. monetary policy for the remainder of the year. The Federal Reserve uses interest rates as one of its primary tools to influence economic activity. During periods of high inflation, the central bank often raises interest rates to reduce consumer spending and borrowing, helping slow price increases. Conversely, when economic growth weakens significantly, lower interest rates can encourage borrowing, investment, and job creation. Following several years of aggressive rate increases aimed at combating inflation, policymakers have recently shifted toward a more patient approach, allowing time to evaluate how previous actions are affecting the broader economy. Officials noted that while inflation has continued to move toward the Federal Reserve's long-term target, it remains above the desired level in several sectors of the economy. At the conclusion of its latest policy meeting, the Federal Open Market Committee, FOMC, announced that it would maintain the federal funds target range without change. In its policy statement, the committee acknowledged continued economic expansion and a resilient labor market while noting that inflation remains elevated enough to justify maintaining current monetary policy. Federal Reserve Chair Jerome Powell stated that the central bank remains committed to achieving maximum employment and stable prices, emphasizing that policymakers are prepared to adjust interest rates if economic conditions require further action. The decision reflects the committee's assessment that maintaining current rates provides additional time to evaluate the cumulative effects of previous policy adjustments. Financial markets reacted cautiously following the announcement. Major U.S. stock indexes experienced modest fluctuations as investors analyzed the Federal Reserve's latest guidance regarding future interest rate decisions. Treasury yields also moved as traders reassessed expectations for possible rate cuts later in the year. Analysts noted that investors continue searching for clearer signals regarding when the Federal Reserve may begin easing monetary policy, particularly if inflation continues to decline. Currency markets also responded, with the U.S. dollar showing limited movement against several major global currencies. For American households, the decision means borrowing costs are likely to remain elevated for the near future. Mortgage rates, auto loans, credit card interest, and certain business financing costs may continue reflecting the higher interest rate environment established over recent years. However, higher interest rates can also benefit savers, as banks and financial institutions often offer improved returns on savings accounts, certificates of deposit, and other interest-bearing investments. Consumers considering major purchases or refinancing existing loans are encouraged to monitor future Federal Reserve decisions, as any changes in monetary policy could influence borrowing costs. Businesses continue adapting to the higher rate environment by carefully evaluating investment plans, hiring decisions, and financing strategies. Economists remain divided over the outlook for the U.S. economy. Some believe slowing inflation could eventually allow gradual interest rate reductions without triggering a recession, while others caution that inflationary pressures may persist longer than expected. The Federal Reserve emphasized that it will continue monitoring economic indicators before making any future policy adjustments. Officials stressed that no predetermined timeline exists for future rate changes, reinforcing their commitment to a data-driven approach. The Federal Reserve's policy decisions influence financial markets far beyond the United States. Many central banks closely monitor U.S. monetary policy because changes in American interest rates can affect exchange rates, international investment flows, commodity prices, and borrowing costs around the world. Emerging economies, in particular, often experience increased market volatility following major Federal Reserve announcements, making each policy decision significant for the global financial system.